Happy Sunday, traders. This is Trader Geek Sam with your weekly review and preview for Sunday, May 17th, 2026. Hope you're having a great weekend, and I've been gone for the past couple of weekends due to a little tooth extraction and kept me a little bit sidelined from doing these videos. Talking too much hurt too much. So I'm back, and hopefully all is on the mend here. So got the stitches out, and we're ready to go. So we ended up a week not on such a good note. Looking at last week's, you can see on Friday, the smaller the capitalization, the harder it fell. Microcaps down 2.64%, small caps down 1.6, and so are the mid caps. Nasdaq losing 1.5%, Dow Jones just basically flat, and the S&P 500 losing 1.2%. Over the course of the trading week, S&P 500 was up 0.9%, and Dow Jones up 0.4%, Nasdaq at 1.77%. Actually, that's 5 days, so that doesn't look like the week. So it was basically Monday to Friday, and mid caps down 0.5%, small caps losing 1.34, with the micro caps up 0.77%. For the month, which is about halfway through at this point. We got through an options expiration on Friday. NASDAQ 100, obviously the king of all, up 15.74%. And maybe this is not just the month to date, that is a 1 month period, but you can see that it's far and above leading the way. S&P up 8.64%, microcaps up 9.36%. So a mere flesh wound on Friday. And you can see year to date, NASDAQ is again up 15%, mid caps and the micro caps just leading the way on a year to date basis. So again, I guess that which has gone furthest has fell the most on Friday, but still up 17.5%. So you can see on a 1 year basis and a 3 year basis, lots of green on there. As for the sectors, everything was in the red except energy up 2.36%. You see technology getting hit 1.8%, utilities 2.29%. They have not been doing well over the past month. Basic materials getting hit with gold and precious metals giving back a lot of their gains from the past week, and real estate losing 1.55%. Over the 5 days, 4 out of the 11 sectors were positive. The rest were in the red, with consumer discretionary getting hit, with Amazon and Tesla being their largest components, getting hit to the tune of 3%. Over a 1 month basis, again, consistent with the NASDAQ, the technology is up 17%. Consumer staples, surprisingly, up 4.42% despite the strength in technology. And energy, on Iran wars, fears, and blockade of the Straits of Hormuz, up 6.6%. No surprise there. But you can see year to date technology up 22.43%, only usurped by energy, and of course has a lot to do with the war in the Middle East. Industrial up 10.5%, and basic materials up 10.5%. So if you were up a lot, you were down a lot on Friday. But again, it's only 1 day. On a 1 year basis, technology stealing a show up 50%. And next in line and closest is energy. Industrials 20.5%. No, there you go. Energy, and then industrials 20.57%. So not a good day on Friday, but overall, is it a portending more weakness to come? We shall see, and I'll get into that in a minute. On a factor basis, you can see that the worst was momentum getting hit on Friday, and that's what usually happens, especially in a momentum-driven market like we've had for the past several weeks. And the strongest, if you can call it that, dividend growth still down 0.6%. No factor was in the green. And the best over the last 5 days has been low volatility. But honestly, low volatility on a year-to-date basis is just flat on the year. So it hasn't done anything. Same if you look at quality and you look at dividends, they're just not performing very well, or relatively speaking, but still respectable gains. You could say dividend growth of 5 and equal weight RSP relative to the S&P 500, which we said is up 8.25%. You can see the weighting of tech is making a difference in the equal weight kind of underperforming. On a 1 year basis, you can see growth up 32% and momentum consistent with that 30.2%. And only USMV, basically treading water, up 1.74. And USMV is low volatility stocks, has a decent dividend, but really not a great return. But this is kind of a complement to higher beta funds that you might have in your portfolio. You can see over 3 years, it's still respectable, up 28%. Looking around the world in terms of style of investing, everything got hit last week, and emerging markets, which had been up the most and still are the most on a year-to-date basis, lost 3.4%. If you just look outside the US, it still lost 2%. Developed markets, and I presume that includes the US, down 2.1%. And on a year-to-date basis, they're all nicely in the green, though the lead that these global equities had over the US markets is still there, but not as much as it was last year. But you can see emerging markets has done very well year to date and on a 1 year basis. So emerging markets, kind of their demise is somewhat greatly exaggerated, so to speak. If you look on a country basis, it's interesting to see, but a lot of red, and you can see all of them over the last 5 days are in the red, and even more so over 1 month. US and Japan in these major countries are the ones that are positive, and year to date, we've got a little bit more, but Germany and France and China still down year to date, which is kind of strange given this everything market, or um, where everything is rallying. But of course, can't say that about Bitcoin. It has rallied, but gave back a bit on Friday. And taking a look at the bonds, if you want to give approximate cause of the weakness, other than the fact that we were overbought and breadth was deteriorating for days. Interest rates rising on Friday is a key factor, and the TLT lost 1.5% on Friday alone. But you can see all sorts of bonds were down on Friday, as were they over the last 5 days. And over the last month, interest rates have been rising across the spectrum of bonds. So it's not like Friday was something new. It got the 10-year bond above 4.5%, and that's kind of a line of demarcation where people start to get concerned about rising interest rates. But we had a healthy bounce since the first of the year in the bonds, and I'm not surprised to see things kind of getting back in line with inflation fears and the fact that we're changing out. We got a new Fed head coming in, Kevin Warsh, starting on Friday. I think this was welcome to being head of the Fed. Let us show you who's in charge. And in any case, TLT down 4% on a year-to-date basis. International government bonds, which were doing fairly well, down 3.2%. The only one that's up is TIPS, and this is an inflation-protected bond, so no surprise there, given that inflation is remaining sticky. Aggregate bonds just, barely hanging on to 0.43% gain, but over 3 years, very mixed bag. Tips and high yield bonds, which pretty much behave like equities, they still have quite a bit of beta to them uh, in terms of calling them bonds. Short-term corporates up 3%. Commodities, mixed bag on Friday. Just oil and natural gas, the energy complex up as we saw in the energy sector, and a mixed bag over the 5 days. And we also, on a month-to-date basis, gold losing 5%, silver 3.9%. Silver had a great day last week. I think it was Wednesday or Thursday, but got little follow through and gave back quite a bit on Friday. And so did gold and the other precious metals. On a year-to-date basis, gold is still up 5%, silver up 7%. Oil is the ringleader, up almost 90% on the year. Natty gas, even though oil is up, is still down 7.59. This thing can't seem to sustain any strength despite natural gas shortages around the world. We just need to build enough UNG plants, look for LNG plants. I should say not UNG, LNG plants to get this natural gas distributed to the more expensive parts of the world. But I mean, on a 1 year basis, despite the strength in energy, natural gas down 33%. And they're measuring it by the UNG, which is not a great instrument to measure natural gas. So, but on a 3 year basis, it's still down. Corn is down a lot, and nothing comes close to gold over the last 3 years. And I don't usually look at currencies too much, but all it really matters is, US dollar was very strong on Friday, which lends to the weakness in the precious metals, of course. But euro, Japanese yen, British pound, all losing ground. But despite the calls for the demise of the dollar, you still have the dollar up 2.74% relative to some of the other world currencies. We don't have the yuan here, but that's also been weak. So on a 1 year basis, euro has been strong. It's up 4%. Over 1 year, and the British pound is still eking out a slight gain, but for the most part, over 3 years, they have shown relative strength to the dollar, but you can see the yen and the devaluation there. So let's take a look at what's happening with the charts. And for those of you that are new to my videos, I am a top-down trader, and you can see that I have a daily, weekly, and monthly chart here. And so we can take a look here and see that, what a run it's been. You might even call it, yeah, you can call this parabolic, from all the way to the lows at 6,300 all the way up to 7,500. That's 1,200 points without nary a pullback. And but we got that on Friday, and one day does not make a trend, but definitely not what we have been seeing. You can see the closest thing was this candle here. Could we pop right back up on Monday? Absolutely. We didn't trip a parabolic stop and reverse dot here. So that volatility stop was not, actually, it's more of a momentum stop, not a volatility stop. Did not trigger. And we shall see. It's holding this yellow line being the 8 EMA. And you can see that on Thursday, we hit the upper edge of the options implied expected move. And for those not familiar with the expected move, we would expect that the indices would stay inside the options implied expected move 68.3% of the time. And the last couple of weeks, it has not. So we have moved outside of that to the upside. But this week, we kind of hit it and pulled back. And that was a give or take 110 points for last week. You can see I put in the expected move for this week, the red line and the green line. And this week that jumps to about 133 points for the week. And even though volatility did not jump that much, and even though we don't have that much in the way of really uh, important or market moving economic reports, and most of the big market moving earnings are behind us, you can see that it jumped 23 points. So that's a big jump for the week. So indicating an expansion of volatility. MACD still on a buy signal, but coming in sideways. We'll see if this fast line, the blue line, crosses below the signal line, and see if we get some type of selling. But you can see on Friday that the relative strength index, the RSI, finally dropped below the overbought level into 67, the 70 level being an overbought level. And it was there for quite a while, and finally got up to about 77, almost 78 here. So in some systems, anything over 75 tends to trigger a bit of selling. So still haven't tripped the bullish chandelier shear. We have the chandelier stop, and that chandelier stop is down here. Or right here at 7,300. We need to close below there. And that is a volatility stop. So this stop, um, if triggered, would portend a further pullback here. But I have a feeling that that's going to hold at least on the first test. And who knows, we might be back up and away on Monday. Switching over to the weekly chart, you can see that we have kind of a doji, high-tail doji here. And after making a new all-time high last week, we closed slightly below the middle of the range. And the first in the series of candles. Look at all of these beautiful candles. And then we finally got a doji. MACD is definitely on a buy signal, and the RSI is right smack at the overbought level at 69. Never really got into the overbought region on a weekly basis, but that can still happen. Looking at this particular candle, when I see a candle like this, it tells me that I'm going to watch for a movement above the high. We make a new all-time high, or we move below the low, which is 73.38. And if we get a close below that weekly low, then that might portend more weakness on the way. But 73.38, when I see a doji like that, I usually go with whatever happens on the upside or the downside. And of course, since it is a weekly candle, what really matters is what happens after the Friday close. Is it below or above, or maybe we have we have an inside week. We shall see. Switching over to the monthly, nothing wrong with this. Nice candle, a little bit of a top in there, but we're only one half the way through the month. You've got a bullish chandelier, bullish PSAR. Both stops are positive. MACD not even flinching. Like I said, Friday is only one day on a buy signal. The RSI pretty strong, red hot in the overbought area. It's going to take a lot to change that. So nothing here says there's anything other than a very bullish market, and it deserves the benefit of the doubt because you've got a monthly that's bullish, you've got a weekly that's bullish, and you still have a daily that's bullish. So we just had one weekday, and we need more information to see whether we're going to continue to see weakness, or we are going to pop right back up after Friday's options expiration. Keep in mind that OPEX does tend to trigger a bit of volatility of its own, and there can be some shenanigans that we could see. But I'll wrap up with some of my thoughts, my personal thoughts and opinions. But switching over to the NASDAQ 100, and you can see here, candle looks a little better than the SPX. It's not a solid red candle, but still a doji. But again, Anything above the high 29,387 or below the low 28,991 could portend a movement below or above. Again, we held the 8 EMA. That's important. We held the parabolic stop and reverse stop, so that's still good. But it does look like the MACD is coming in for a crossover. We'll see if it ends up going sideways or the fast line crosses over the signal line. We'll see. MACD is still red hot in above the 70 level, so that's good. But for the most part, just one weekday losing 1.5%. On the weekly chart, you can see here's the doji. Again, looking to the top or bottom, see if we stay inside of it or go below or above it next week. After 1, 2, 3, 6 beautiful candles, we finally got a bit of weakness. So you could say that we lost a little ground, but barely a flesh wound. You call it about, say, less than just a little over 100 points on a $29,000 index. Anyway, the MACD solidly positive, and it is definitely red hot relative strength index here in the overbought. And that's what bull markets do. You have an overbought RSI and they stay overbought. Chandelier and PSA are definitely still green and positive. On a monthly basis, you can see here a little top here, only halfway through the month, and nothing wrong with this picture here. MACD solidly positive, and we are overbought on the RSI. And you can see we go through long stretches of it staying overbought, and that's what bull markets do. I didn't mention that the NASDAQ, the options implied expected move for the coming week is about 802 points, give or take. And for the week, we were right smack in the middle. These grayed outlines are last week's implied moves, and then you can see oddly enough, the upper edge of the implied move this week is almost identical to last week's, but the lower edge is a little bit below. These grayed out ones are last week's, and the green ones, green and red, are this week. So NASDAQ, bullish, bullish, bullish. Long needed pullback. So you can't really say that there's anything bearish about this. So bulls deserve the benefit of the doubt. Russell 2000, or basically the small caps. Whoops. Oh, we've got a bullish chandelier. We did have a flip of the parabolic stop and reverse stop to bearish. We took that out on Friday. So nothing here that is more than what looks like consolidation here. We did take out the 8 EMA, but we're holding the 21 EMA, which is more of an intermediate term measurement. We did come right to the bottom edge of the options implied expected move, and we somewhat held it on Friday. And you can see that the MACD has flipped to a sell signal, and the RSI, which barely peeked its head above the overbought level, came in at 52 at the end of the week. So a little bit of, it would have been nice, or it will be nice if it holds this area here. You can see that there's a lot of activity here. So I would count this as support. For the week, the Russell has about 75 points, give or take, on the coming week. You can see that here in the green and the red lines. And we'll see if the Russell still leads the way down. They tend to be the most sensitive to the interest rates. So that's why they probably got hit more than the others on Friday. Looking at the weekly chart, still a bullish chandelier, bullish PSAR, and you can see we just essentially reversed the prior week's gains. We took them all back, but not a pretty candle by any means. But the MACD is still positive. RSI is at the 63 level. So we kissed the 70 overbought level and pulled back from there. Still looks really good, and consolidation is a good thing when it comes to indices that have been hot 1, 2, 3, 4, 5, 6 weeks in a row. Going over to the monthly chart, you've got a big topping tail mid-month here on that. Well, hopefully that gets repaired and looks a little bit better by the end of the month. But after a strong month in April, May is so far looking a bit toppy, but it's still early. MACD is solidly positive, and we have not hit the overbought level on there. But what can I say? Bullish, bullish, still bullish here. But if we get more weakness, then we might take out this chandelier stop right down there at 27.67. And it is within the range of possibility since our options implied expected move. The lower edge is down here. So we'll see what happens. Flipping over to the VIX, you can see here that we made an attempt. We finally got a green candle in here, but look at closing in the lower end of its range. And this red line here is the 200-day. So we didn't quite get a close over the 200-day. And before I get too concerned about what the VIX is doing, I want to see two closes above the 200-day. We're right there, and we could get it on Monday. We'll see. But a bit of a topping tail. We saw the market open really weak. It bounced quite a bit and then sold off at the end of the day, and even more so after hours. So there's options expiration shenanigans going on. So we don't really know what really caused that end of the day weakness and even the aftermarket when there was a whole bunch of futures dumped. But in any case, 18 and a half, and we peaked on Friday at 1927. We couldn't even hit 20 on Friday. And for those of you who don't listen to me every week, 19 and a half is the long-term average for the VIX. And we're below average on the VIX, even with a crappy day in the market. So weekly, looking like a doji. Again, you could look at this and say, okay, we go above the 1927, VIX is heading higher, and if we go below 17.2, we're going lower. So the big thing that I've been harping on is that even though we're making new all-time highs, and we were making them almost every day or every other day, we couldn't quite break the 16 level on the VIX. Where is the 12 level of VIX? Where's the 14? Where's the 15? So that told me that there's still a lot of hedging going on, and it's not ready to let go and really throw caution to the wind in this market. There's still some hedging going on here. So the other thing I like to look at in connection with the VIX is if I can type the VVIX, and that didn't even hit the 100 level on Friday. And the 100 level, 100 to 110 is kind of the warning track. And the volatility of the volatility is a measure of institutional VIX call buying. And it's just a red candle here. We closed on Thursday at 94.26. And then on Friday, we closed at 92.94. So we closed lower on the VVIX and made an attempt to go up, but we never even kissed the 100 level on Friday. So that tells me that there wasn't a lot of fear going on Friday to send in a rush for VIX call buying or hedging. So still not on the warning track. VVIX is not screaming, we're about to collapse here. But as you all know, that I like to take a look at VIX option pricing, and 1843 as we end, let's call it 18 and a half. And if you are bearish on the market, you're going to go out. We have a VIX option expiration coming up on Tuesday. So I'm going to go out to the June monthly expiration. That's where the most liquidity is and is within reason in terms of measurement of current volatility. So we're at 18 and a half. And if I'm bearish on the market, I'm going to buy VIX calls, right? So, and those are pricing out at $2.41. So, get my trusty calculator out here and 2.41. And, but if I was bearish on the VIX and bullish on the market, then maybe I'm buying puts on the VIX. And so I would go $1 out of the money. That's 17 and a half, and that's 31 cents. So divide that by 31. And so at one point on Thursday, the calls were trading for 30 times the equidistant puts. And as of Friday's close, it was still advantage bears 7.7 times. Did I do that right? Yeah. Just didn't type in the decimal. So 7.8 times the calls versus the puts. And that gives a feather in the bears camp, saying that usually when the selling is exhausted, and I don't think the selling was exhausted on Friday, you would see parity between the pricing of the out of money calls and the out of money put. So VIX putting a feather in the bears camp. So SPX, take a look here and just double check. Yeah, 133 points is the expected move for next week. So, and if you really want a percentage, it's about a 21% increase in terms of the expected move over last week. And when you consider that the VIX wasn't up that much, it just tells you that there's a little bit more fear creeping into this market. So, what do we have going on next week in terms of economic reports? Taking a look, Monday we have Atlanta Fed talking nothing really in the way of economic reports. Pending home sales on Tuesday with Philadelphia Fed and Atlanta Fed. Closing remarks, whatever those are. Wednesday, we get the minutes of the FOMC meeting. And then Thursday, our typical jobless claims and housing starts and building permits and Philly Fed manufacturing survey, PMI. And Friday, we get consumer sentiment and leading economic indicators. So no red star really events here to speak of. So nothing major in the way of economic events. And speaking of no major, we have an earnings cycle that is starting to wind down. But this is what I call a retail reporting week. We got Monday Baidu before the open. And on Tuesday, we have Home Depot also before the open, Kava reporting. And if Toll Brothers, as far as home builders, we'll get more information about how higher interest rates are affecting new home sales. ADI, analog devices, before the open on Wednesday. And here's our parade of retailers, Target and Lowe's reporting, and so is TJX in the morning, and a little company you might have heard of, NVIDIA, after the close, and that's going to create some volatility one way or another into it in the software space. We'll hear from them what they have to say about AI and what have you. And then Walmart, big retailer, John Deere, before the open on Thursday. Deckers Outdoors, more retail, and I guess well, yeah, I guess that is retail. Zoom and more retail, Ross, and then on Friday we get the junior Costco BJ's reporting before the open, as well as Booz Allen Hamilton. So. In any case, that's kind of the story for this week. And if we come back to the charts, we were starting to see some signs, and we have been seeing signs of being overbought, breadth not great, and even on Friday when you look at the S&P 500, it wasn't a rout. Basically, 67 components of the S&P 100 were down and 34 were up. And what we've seen on other days this past week or so is just the opposite. 30 to 40 components up and 60 down. Or I'm sorry, 60 up and 40 down. We haven't really seen these strong, really breadth of days, either to the upside or downside. And that might point to some degree of rotation. But in my opinion, this market is in need of a breather. We're coming into a seasonally less positive part of May. And, you know, the other concern I have is this market did not do a lot of back and filling on the way up. So there's going to be, if there is more weakness, as I like to say, coming down here would be like a hot knife through butter coming down because there's no consolidation here. Maybe we pause here at the 7,300 at these round numbers, but if there's weakness to be had, there's not a whole lot of support on the way down, given how fast and furious that we went up. So that's my main concern, and my idea, my thinking is. Protect those profits. You've already missed the top on a lot of stocks, but don't hang on to stuff that is just giving back your profits. So, kind of the same skills that got you to your account level today are not the same ones that are going to help you when the market is coming down. You've got to protect those profits. Otherwise, you're going to see Mr. Market teach you how risk management or the failure to manage your risk will take back a lot of those trading profits. So don't be concerned about your high watermark. Be concerned about protecting your profits and decide ahead of time where you're going to get out of some of these stocks that have had some great runs. And yeah, they may come back, but you can always get back in. All right. So caution is warranted. My guess for the week is lots of volatility, big surprise, and my guess is sideways to down. I think we will see some two-way action, but my guess is we're going to see a little bit of follow through from Friday's action. I don't see a collapse here. There's nothing here that tells me that the bulls have left the building, but at this point, we need to be cautious and preserve those profits and not get too complacent, given that we've had an excellent run and a little bit of back and filling will definitely be a good thing for this market and open up other opportunities. I appreciate you watching and listening. If you have any comments for me, at TraderGeek on Twitter, or you can leave them with the video or in one of the forums that you find me in. Take care. Have a great rest of your Sunday. And again, thanks for tuning in. Trader Geek Sam over and out.